Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question. How does indexed universal life insurance work? This is a great question. I've wanted to answer this one for a long time, and I've kept getting this question for years and years and years. And I haven't really given it a thorough answer. I'll try to cover, I'm still kind of debating how in depth I want to go with this. Indexed universal life is a very complex product that's often pitched as a very simple product. The sales pitch we'll start with the marketing. The sales pitch for indexed universal life is simple. So when an insurance agent approaches a prospective client, they come to you and they say, listen, I got this great product. You get upside potential of the stock market without any downside risk. That was the original sales pitch. When I started in this business in 2004, and then I went independent in 05 or 06, and there was a lot of, there weren't that many insurance companies that were selling IUL. It was basically, at the time, it was Ameris Life, which then was bought out by Aviva. I was in New York, so that was Bankers Life of New York, and then they got bought out and became Aviva Life of New York. It was all kind of under the same kind of umbrella. So, and Aviva is this big European insurance company, and they came in and they took over a lot of Ameris Life's operations. So, and there weren't that many other sellers. So that was basically, if you're going to sell IUL, that was the company you're going to sell for. And there were a couple, it was the only, but there were a couple others, but that was the big one, right? And that was the sales pitch. It was, get the upside potential of the S&P 500 without any of the downside risk. And that's still kind of the sales pitch, although, a lot of agents now are talking, the way they frame it now is like upside potential with downside risk. And it's sort of a shortened version of it. It's like upside potential of what? Upside potential of the S&P 500. Well, it's the upside potential of the pricing action, the price action of the S&P 500. So Index UL, the way it works is that, first of all, it works in the chassis of the product, the foundation or the chassis of the product works just like every other cash value life insurance product, meaning when you pay the insurance company premiums, and now in an IUL, you don't have a guaranteed level premium. In a UL policy, a universal life, you don't have any guaranteed level premium. It's all planned, what's called planned premium, meaning you plan to make a certain premium, but the insurance company does not guarantee that the premium will stay level. It's not a premium that you have to pay, and it's not a premium. There's no premium that's due. They're going to bill you a premium, but they're not going to say you have to pay this. There's no required premium. There are required charges, which sounds kind of like it sounds sort of like a semantics, but it's not. So there's a big difference between having a guaranteed level premium or required premium versus having required expense charges. The insurance company doesn't care how much premium you pay. You could pay $10,000 in 1 month, $0 in the next month, $50,000 in the next month, and $0 in the month after that. What they care about is that there's enough money sitting in the cash surrender value or the cash value of the account to cover all of the policy charges, mortality charges, other expense charges, and so on and so forth. In the case of IUL options budget, if they've worked, the options budget usually gets worked into those expenses. As long as there's enough money in the cash value account, they don't care how much you pay. You could make one premium a year. You could make, 2 or 3 premiums a year. You could vary your premium every single month, and they don't mind. They don't care. It doesn't matter to them. And so it's not really a premium driven product. It's an expense driven product. So every month the insurance company is going to deduct expenses. They're not going to tell you have to make a premium payment. What you do is you have what's called a planned premium. They set you up on a billing system, a billing schedule, and they'll do a monthly draft or whatever, or you can just cut them a check once a year or a couple times a year or whatnot. But the product itself has no guarantees baked into the contract. There's nothing baked into the product that says there's going to be a certain amount of guarantees, certain interest rate guarantee, and so on and so forth. As a result, these products do not endow, meaning the cash value is never guaranteed to equal the death benefit at age 120 or 121. So what happens is the insurance company sets up this product, says, okay, you can pay whatever premium you want to pay. We're going to deduct these charges every month. So premiums go into the cash value account. The life insurance company deducts expenses, and then whatever's left over gets credited with interest. So premiums in, expenses out, credits back in. That's it. That's the product. Now, with the credits, there's a couple different ways you could do it. In a whole life product, there is a guaranteed level premium. Okay, so the insurance company says you have to pay this premium either out of pocket or using existing policy values. One way or another, we're collecting this premium. And then don't worry about the charges. We'll handle that on the back end. But in order to meet the guarantees of the product, and that's the other thing, because the product is fully guaranteed, guaranteed cash value, guaranteed premium, guaranteed death benefit. In order to get all those guarantees, we must collect this premium. We've already figured out what we need. You got to pay this every single month or year. And that's it. No questions about it. So it either has to come out of pocket or it's got to come from the existing policy values, cash value, accumulated dividends, paid up additions, so on. It's got to come from somewhere. It has to be paid. And in a whole life, the interest credits come from the performance of the company. So they're taking all your premiums, investing them, and then excess interest on bonds, investment gains that they get from their investments, anything that's in the interest maintenance reserve if they need it, profits from supplemental lines of business. So if the insurance company runs like they sell a lot of term insurance, or they sell annuities, any profits from the disability insurance, anything like that, long-term care insurance, all the profits from that go to interest credits on whole life. With universal life, they can do something similar, except most of the interest credits are going to come from the carrier's bond portfolio. So any excess interest over and above what they are going to pay. Well, actually, no, it's just interest, whatever interest they're generating on their bond portfolio. So they don't have they may have they might have a minimum guaranteed gross crediting rate of, let's say, 2%. Okay. So they have to pay at least that much. All right. And then whatever they earn, after, of course your expenses come out, but then whatever's left over gets credited with whatever they've earned on their bond portfolio. It has to be at least that minimum guarantee crediting rate, which is, by the way, not a guarantee on the cash value. It's just a guarantee they're going to pay that certain crediting rate. So it's a minimum crediting rate of just the 2%. The expenses could exceed that crediting rate. So they don't, usually what happens in a UL is they'll have it set up so that the minimum crediting rate and the maximum policy charges will sort of create the spread. So the charges can be higher than the crediting rate. I won't go into why they do that, but basically the carrier's going to, on a normal UL, says we're just crediting you interest based on our bonds, whatever interest we get on our bonds. In an IUL, so that's all of how the normal products work. The IUL says instead of giving you the interest credits that we got from company performance or from our bonds or investments that we made, we're going to buy call options on the S&P 500. Options contracts are like derivative products. An option is the option, the right, but not the obligation to buy or sell a security. So in a case of an equity option, it's the right to buy or sell the underlying index at a specified price for a specified period of time. That would be a call option to buy. The option to sell would be a put option. So you've got call options, the right to buy, put options, the right to sell. Usually what carriers are doing is they're doing a call option. So they want the right to buy, right? Because they want to capture upside potential. And then if the loss is if the options expire worthless, then there's no profit to be made and you get a zero crediting. And hopefully there was some interest from bonds that kind of makes up for that a little bit, and the carrier's going to guarantee you net out at zero. So what the insurance companies are doing is they're not just going to buy call options because they also want to hedge risk. So they're going to do something called a bull call spread. And that's a more complicated version. It's a call option strategy, but it's a more complicated version of buying options. So a bull call spread, a debit spread on the S&P 500. So the carrier is using the premiums, investing in bonds, slicing off a little bit of interest from the bonds, and doing this bull call spread, hopefully to get some extra interest credits that it can apply to the cash value for the policyholder. So here's the basics of how it works. So the carrier is going to buy a call option on the S&P at a relatively low strike price. And at the time of this recording, when I'm doing this, the index, I know the index changes daily. It's actually up over, so let's just say at the time when I was working out the math that I'm showing you now, it was at $5,980.87. It looks like it's going to go over 6,000, but right now it's $5,980, right? So they would buy, if they're going to do it today or at the time of this recording, they might buy let's say an at the money call option. This is which is called a long call, and it gives them the right to buy the index at that price, at the $59.80 price, for 1 year from now. If they do a 1 year option, and most of them are doing like a 1 year point to point. So if you look on the IUL contract, it'll say this is a 1 year annual point to point indexing strategy. That's what that means. It means they're buying a long call for 1 year, kind of like a leap almost. So it's a 1 year call, again, for a 1 year point to point strategy, which is the most common for IULs. That's what a lot of the carriers, that's the most basic thing to do. It's the easiest for them to do. Then they pay a premium for this. When you buy an option, you got to pay a premium for the option. Which is kind of like a fee for buying the option. So they pay a premium, which is then charged to the policyholder either directly or indirectly, through policy charges, and they have different ways to kind of bake that into the total cost of the product. You're not going to see it. It's going to be baked into the charges. They're not, and most of the time I haven't seen it where they actually break it out and say this is how much you're paying for the options budget and so on and so forth. It's just baked into the total expenses. So usually policyholders aren't made aware of the insurer's options budget, how much money they have set aside to do all this, but it is baked into the cost structure there. So the carrier, after they buy the call option, then they turn around and they sell a call option simultaneously at a higher strike price with the same 1 year expiration. So this is called the short call, and what it does is it obligates them to sell their position in the index at that higher strike price. If the buyer on the other end, so they're selling an option to someone else. So if the buyer on the other end decides to exercise it, they have to sell at that higher strike price. And for selling the option, they receive a premium. So instead of paying a premium, they receive a premium because they're the ones selling instead of buying. They receive a premium for selling the option, which helps offset the cost of buying that long call. Typically the way these are set up, there's always it's going to be a net debit, meaning there's a net charge for it. So that when they sell a call, they're not usually not getting enough money from that to offset the price that they're paying for the call. And this just has to do with how options are priced. They can't, the way the pricing works, they just can't make it so that they're receiving a net credit for that. Not the way that they're setting up this strategy. There is a way to do a net credit spread, but they're not doing it that way. It's just the way that they have to set these up. So there's a net debit for this transaction, and reasons because the premium paid for the long call is typically higher than the premium that's received for the short call. And this is the insurance company's maximum loss, which is fixed at the net premium paid. So these are all theoretical losses in an IUL. The policyholder never sees this explicitly because this is all kind of underneath the hood. You don't usually open the hood and take a look at the engine, what's going on inside there. This is what's going on in the engine underneath. underneath in an IUL. So these are theoretical losses. There's no guaranteed gain in the price action of the underlying index. And so insurance agents are telling you the truth when they say that you can't lose money in these products, because you can't if, right? The key word is if we are talking only about the losses on the index, okay, on the prices of the index. So, but you can absolutely lose money from the net charges to the cash value. So the insurance company has, policy charges, and those charges absolutely can exceed the credits that you get back from this option strategy. And sometimes you see this, it can be substantial. That doesn't mean they will be. It just means but they can be. They absolutely can be. So the carrier will credit interest, if any, based on any options profits that they get from this strategy. Okay, if the index price at expiration is at or above the higher strike, which is the short call, then their profit is the difference between the strike prices minus the net debit paid multiplied by 100, because there's 100 in that's per contract. There's 100 shares per contract, and that net credit amount, if any, gets transformed into quote unquote interest credits, right, on the IUL, and then it's credited to the cash surrender value, and that's it. That's your product. That's how it works. So the maximum loss potential for this type of strategy is limited to the net debit paid, the cost that's paid, right? If the index price at the expiration of those options is at or below the lower strike price. In other words, the long call strike price. The break-even point is the lower strike price, the long call strike price. That plus the net debit paid for the call spread. I know that's kind of complicated, but rewind this if you need to hear that again. It's the break-even point is the lower strike price, plus the net debit paid for the call spread. Most carriers are using a 1-year point-to-point index strategy. So again, it's because it's the simplest. So the longer expiration gives the index a longer time to move and possibly a higher chance of being in profit. And that's why they do it. If you do a 1 year, you got better odds. If you're doing like a 1 day, it's like short odds, right? If you do like a 1 month, it's likely longer. If you do a year, it's longer. If you do 5 years, it's even higher profit potential. The trade-off is that there's a higher net debit for this, which ultimately gets charged to the policyholder, either directly or indirectly. And just because of the way the options work, time decay, which in the options world is called theta, affects the position more slowly early on, but then of course accelerates closer to the options expiration. So an example of this would be, I have an example written down here. Okay, so let's take let's say the index is at 59.80.87, so $5,980.87. So let's say you buy a call at the 59.80 strike price, because they don't do odd cents. So let's say it's just at the 59.80 strike. And I'm just going to make up dollar amounts. The dollar amounts are going to be different, but let's say you buy it for $5, right? So you pay $500 because it's 5 times 100. 500, you get 100 per contract, 100 shares, or 100 shares per contract. And it's like 59.80 quote unquote per share of the index. So you pay that and say it's $500, right? Then you sell one call at a $6,000 strike for a $3 premium and get $300 for that. So you paid $500, you got back $3, you're net $200, right? That's your max loss. That's how much the insurance company can lose. Max profit would be the $6,000 minus the $59.80, which would be $3 times 100, would be $107 per share, or $10,700 per contract. Okay, so your break even on that would be a 59.83 index price at expiration. So the real costs and credits, these are just kind of like made up numbers. The real costs, what you have to do is you have to actually go in. You can go into like you have a Charles Schwab account or a Fidelity account or whatever. You can go in and actually you can look at the options chain on the S&P, and you can see like what the carriers would actually be paying, right, for these options. Now they're doing this at scale. right? But as an individual, you just get like a general idea of like, oh, okay, well, this is what it is, this is what they're paying, this is what the prices are, this is how much they're collecting, and just, and run the math. But the prices would be different based on current market conditions, options pricing, implied volatility, and so on and so forth. So the real costs and credits are going to be different than this example, right? This is not like something you should take to the bank. These are just kind of made up numbers. And then the carriers are going to work out where they think the best short position should be based on their options budget and the potential they want for the contract. But that's the basic idea of it, and also the spread. When they're working out, when they're doing the spread between the long call and the short call, that's basically going to be their cap rate. If they buy it at a certain strike at the money and then they go up like 10%, well, guess what? Their cap rate on that product is going to be 10%. If they go up 5%, cap rate's going to be 5%. It's because that's where those shares are going to have to be called away. So that's the quote unquote the limit, right? That's where they're when you see cap rates in products, it tells you kind of how far up on the strike they're going, how much higher they're going on the strike price to give you the profits in the contract, and hopefully it works out, right? That's what they're kind of hoping, that everything's going to work out and you're gonna max out your cap and you're going to make a bunch of money off of it. Now some carriers do have uncapped crediting options, and they're not where they're not necessarily using a call spread. They're buying the long call, but then they're hedging it with a spread that they charge to the policyholder. So when whatever gains are made. So the spreads are usually pretty big. I've seen spreads that are like 6-8%. Sometimes they're lower. I mean, I've seen like 4 or 5, but they're usually pretty big. It's usually a pretty big spread, because the carrier has to figure out how they're going to hedge that, and how they're going to make, come up with the money to make this work. So let's say on a 10% gain in the index, and if you got a 6% spread, you're netting 4%, which doesn't sound like a lot, but that's what you get. If you went up 20%, you profit even more. You wouldn't be capped out. Like if it was a 10% cap, you'd be, and the index went up 20%, you'd be better off having the spread, because you'd make more money, So rather than being capped out at 10% on a 10% cap, right? Rather than being capped out at 10%, you'd make, 14%. So you'd make 4 percentage points more. You'd have to determine whether or not that's worth it to spend the 6% spread on that, And you won't know that beforehand. But if you're really bullish on the S&P, then maybe you want the uncapped option. So, sometimes, and another thing I've seen is insurance companies will offer a monthly point to point, where they're resetting it every month, or a monthly average crediting strategy. It's the same basic concept as before, but some of the details are rearranged and they change how they do some of the buying and the hedging. The carrier is still using call options or a variation on the bull spread to generate those interest credits. And they're not profiting on the upside of that. They're just, because again, they're buying and selling options, and they're just waiting for the thing to get called away, and that's how much they're going to make. They always profit from policy charges. Always remember this. Carriers are always profiting from policy charges, not gambling on the index. They leave that for the policyholder. There's no magic in the insurance business, okay? And insurance agents have been kind of putting on quite a show for policyholders for decades with IUL. I like to say there's there's no magic, only magicians, and the agents are the ones putting on the show, right? So the insurance companies use this strategy and sell it to policyholders because they expect a moderate rise in the underlying index price. They don't do it because they expect runaway price action. If they expected that, they would try to sell more VULs, the variable life, and include index funds in the VUL. What they're expecting is moderate price rises, and the policyholders, if you buy this, that's what you should expect. You should expect either flat or moderately rising index price for moderate credits in your cash value. Because otherwise, because that's what makes sense for the IUL product. I know a lot of people have been sold this thing, told that it's going to make a bunch of money, and this is what you're going to get massive upside, but you don't have to take any market risk, and you're going to make so much money. But that's not what these products are built for. They're built for a moderate rise in the index, right? Moderate, and no dividends, because it's a call option strategy. You're not investing in index funds, so you're not getting dividends on the S&P. You're just making money on the call spread, on the options profits from the call spread. So, but clients, agents are pitching this to clients as this way to get, massive upside potential with no downside risk. They don't say this, but the implication a lot of times is that you can capture most or all of the upside of the stock market. But as you can see, this is just not true. Agents tend to downplay the cap rates or participation rates. It's just not as sexy. It's not as sexy to talk about them because that's where the limiting factors are, right? And then, and also it brings the product, if they did talk about that, it would bring the products squarely back into the fixed life insurance box, right, where it belongs. And, when you hear fixed life insurance, you usually think like conservative returns, like nothing that's too volatile, and it's just not exciting, right? And that's what, and the whole thing with IUL is it's supposed to be exciting. It's supposed to be a really exciting product where you can make a lot of money. But it's nowhere near, but it's not, it's a fixed life insurance product. Okay. It should be nowhere near the investment box, nowhere near it. But at the end of the day, that's what IUL is. It's a fixed insurance product. So, that's it. And by the way, something else, like if you talk to options traders, and by the way, I'm not trying to throw a wet blanket on IUL. Okay. It does exactly what it's supposed to do. It's not a bad product in that sense. What's bad about it is that agents try to make it into something that it's not. And clients are expecting it to be something that it's not. And when it's not the thing that they thought it was, then they get really disappointed. Okay. Ask any options trader who does options, who does like a lot of different kinds of strategies. Ask them about bull call spreads. Right. And don't take my word for it. In fact, I asked Grok, you could do a chat GPT, or better yet, talk to options traders who do this for a living. I talk to options traders. I'm, as of this right, I don't know what the future holds, but I talk to options traders who, in forums and stuff, and just, talk to them about not any like getting strategy. They would just talk to them about, because this is going off topic. If you can't tell, I trade options also for myself, not for clients, but just personally. But it's, talk to options traders. What is the long-term expected profit on an at-the-money bull call spread on the S&P 500? The answer is the expected profit over the long term, the expected profit of a bull call spread, an at-the-money bull call spread strategy on the S&P, it trends toward zero, because option prices reflect fair market expectations. So there shouldn't be like this outsized gain that you're getting from doing this. It should, now that's not to say like in any given year that you can't make money. There's going to be years where like you get maybe a spike, right? And then other years where it's down. But the trend should be towards zero if the market is pricing these things correctly. Most of the times they are. There's always mispricings in the marketplace, but they're pricing these things pretty accurately. You're going to see that trend go towards zero. That's where IUL is headed. And if you're not expecting that, it's going to be a big, huge disappointment. IUL is going to credit more over the long term, 20 years, 30 years. It's going to credit closer and closer to a fixed UL product than it will to a variable life product or an equity investment. That's what it's designed for. You have to expect your expectation. That's what it should be. If you're expecting 7, 8, 9% interest, you are going to be disappointed. It's going to behave more like a fixed UL product than it will like anything else. So that's your expectation. And I would just say, just adjust your expectations to that. If you do better, congratulations. That is awesome. But the norm, you want to think like, what is the normal trajectory of a strategy like this? Okay. at current interest rates, in the current interest rate environment. And of course, current interest rate environment is going to change. It's going to increase, it's going to decrease. So at today's current interest rate environment, at the time of this recording, that's the caveat. At the time of this recording, expect a 4 to 5% crediting rate long term. If interest rates trend up and get to like 6, 7, 8%, okay, expect that as your crediting rate. But expect it to behave more like a fixed life insurance product. Anyway, I hope that helps. I don't know if that helps. Maybe that offended a lot of people, but I hope it helps. And again, thank you for sending me your questions, and I will see you in the next. I'll see you next week with another life insurance question. Take care. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.